Good evening, good morning, good afternoon, everyone. My name is Paul Young. I'm going to walk you through the relationship between the Chief Financial Officer working with the CFO working with private equity. Here's my agenda. Here's a bio about myself. I'm a CPA since 1996. I've been working in corporate finance either directly or indirectly for over 35 years. This gives you an idea where equity is heading from 2025 up to 2033. We are seeing a resurgence now in terms of both the size of the deal and the focus areas. So a lot of the private equity deals early on this year have been more in the med tech, technology, data and AI space. But I can see over time more and more emphasis around areas in ESG, especially in circular areas or other areas of technology that take them from the infancy stages to commercialization. Here looks at some of the largest funds in the first half of 2025, and just some of the big players in here. You're seeing Thomas Bravo, Apollo, Linden Capital Partners. These are some of the key private equity deals and some of the key partners involved. This gives you some examples of some funding happening, and both the company perspective, who was involved in private equity, and the sector. As you can see, tech is the main theme on some of these investments. You can also see healthcare is there. So basically, you're seeing a lot of it to do with healthcare and technology. This is a continuation where you can see basically, again, some additional companies and just where they're focused on in the industry as well. When we start talking about private equity, a lot of cases of what I have seen over my career and probably prevalent probably since January, companies pivoting on the need for funding to help them, or they're struggling with transitioning of a unprofitable division. CFOs work with private equity either to sell this, or an entity themselves may sell a division to private equity, and the CFO might be part of that division being sold, so they'll work accordingly with the private equity as part of the turnaround. This gives you an idea of where things are happening in terms of the transactions. They're telling you at least 90 private equity transactions have happened from 2020 to September 2025. The key with anything, and this Kenneth Merritt explains very succinctly here, is that having a good relationship with private sector and private equity or investment banking firms is critical, especially if you're looking at venture capital or looking at any sort of funding, seed funding, or opportunities to improve your cash flow, and just looking at options to better bring value to your assets. It's important to work and have good relationships with advisory groups, and that's what this is basically discussing. When you look at sponsorships, in most cases with private equity, there's looking at certain multiples, whether that's 5 or 6 times EBITDA, that's earnings before interest, taxes, depreciation, amortization. They could be working on specific ratios for a return on investments or a return on equity. There are specific metrics that they want to work with as part of this. So CFOs are very good at showing the footprint of the data, where the company's heading. The criticality is matching the path of the organization, short term and long term, to the various metrics as part of working with private equity as part of the overall sponsorship. When we talk about shifting model, right, private equity tends to have a set period of time that they're going to make these investments. And on average, the holding period is like 5.8 years. So, but some of them are as little as 3 to 4 years, because typically they're trying to get in, do their turnaround, and then sell that company off, either to another entity itself, acquired company, or maybe they spin it off to an IPO and just move that direction. But basically, it's all about maximizing the value of their investments, and then knowing when to get the old saying and get the gambler, knowing when to hold them, knowing when to fold them. The challenges that you're facing with private equity is typically to deal with a lot of it's data. A lot of it's basically economic and uncertainty. We're seeing that with policy pivots from governments around the world, geopolitical events we're seeing as well, can all impact decisions on what businesses private equity will target. This gives you some examples of the what's next for private equity. There's liquidity positions. Again, you got to know when your capital allocation and what money you're going to hold or where you're going to invest and where you want to move forward with in terms of your investment strategy. And you also want to look at the value you created, basically how you want to carve that out as part of the next direction of expansion of that particular investment. Data and AI are playing a critical role in terms of overall automation, and it's all about protecting of IP. So any sort of time around what you're doing is you're going to want to make sure you're doing your due diligence around IP protection. And deal structuring is always about how you're going to fund it, debt, equity, or whatever is part of the best way to move these equity solutions out. I talked a bit about geopolitical landscapes changing in terms of investment criteria. Like organizations will look at where they get best value for return on investment, and we're seeing that where in terms of capital inflow coming to the U.S. because of the U.S. policies are more favorable to business. So anytime where they see less regulatory burden and taxation policies, will give them some fuel for fire in terms of where they make their investments. Investment's a global proposition. It's been like that for over 30 years. So the key is how you maximize your value and your investments across the globe. And like anything else, you need to have the exit strategy in terms of, well, when you've optimized your investment, what's the next path forward for these investments in terms of how you move forward with them. And this gives you just a little bit more about the funds themselves of how these investments do. You'll see more and more ETF funds and other things created. And they're all, again, about maximizing the value of those funds. And then, again, the quality of the assets which you're holding as well.